In today's unpredictable economy, it's more important than ever to invest wisely. Many people believe that the Federal Reserve can save them from financial crisis. But according to Jim Rickards, a financial expert and best-selling author, relying on the Fed is not enough. He argues that individuals should invest a portion of their cash in a specific asset that can provide protection against market volatility. In today's video, we're going to talk about a powerful investment strategy that Jim Rickards recommends for anyone who wants to protect their wealth and achieve financial security. Rickards is a well-known financial commentator and the author of several best-selling books, including The Death of Money and Currency Wars. In his latest book, The New Great Depression, Rickards argues that the current economic situation is much worse than people realize, and that the Fed cannot save us from the coming financial crisis. So, what is this asset that Rickards recommends you invest 10% of your cash in? Stay tuned to find out. But first, why you should listen to Jim Rickards' predictions. If you are looking for an expert in finance and economics, Jim Rickards is someone you should definitely pay attention to. He has an impressive track record for predicting major financial events with incredible accuracy. In fact, his predictions have been so accurate that even government agencies have sought his counsel. One of the most notable examples of Jim Rickards' forecasting abilities is his prediction of the 2008 financial crisis. In 2006, he accurately predicted that the housing market would collapse and that the financial system would be severely impacted. He even warned the US government about the crisis, but they ignored his warnings. In 2008, his predictions came true and the world plunged into a financial crisis. Another reason that you should listen to Jim's predictions is his track record on making accurate predictions. For example, in 2011, he correctly predicted the price of gold would reach $10,000 per ounce. And while this has not happened yet, gold prices have risen significantly since then. He also correctly predicted the Brexit vote in 2016 and the election of Donald Trump as US President in 2016. His predictions are based on thorough research and analysis of economic data, and he has a keen ability to identifying emerging trends before they become mainstream. As the General Counsel for Long-Term Capital Management, LTCM, he played a key role in negotiating a $3.6 billion rescue in 1998. In a recent tweet dated November 15, 2022, he pointed out that he had been warning about the cryptocurrency risks and predicting a catastrophic event like the FTX crash for years. He was quick to see through Kevin O'Leary or Mr. Wonderful's remarks on the FTX crash. In fact, as early as 2017, he referred to the hype around cryptocurrency as crypto hysteria and cautioned that the sector could be exploited by the government and elites for their own purposes. In his 2019 best-selling book, Aftermath, published in the Wall Street Journal, Rickards exposed the artificial inflation of global markets and advises readers on how to prudently protect their assets. He issued warnings about various asset classes, including cryptocurrencies. In a Daily Reckoning article from March 1, 2021, Rickards stated that Bitcoin is a fraudulent asset that would eventually collapse. He cited the 2018 Bitcoin crash as a precursor to an even more significant crash. As predicted by Rickards, the fifth largest cryptocurrency exchange, FTX, closed down, causing the entire sector to collapse. According to Reuters, at least $1 billion of FTX clients' funds have vanished. As Rickards had warned about Bitcoin, the entire FTX business was a massive Ponzi scheme built on deception. This is now evident, and it is the Enron or Bernie Madoff scandal of our time. However, the scope and magnitude of FTX may be greater than both. Why the Fed can't help you. According to Jim Rickards, the government and the Fed are helpless to address the current economic turmoil caused by supply shocks. The issue is more than just oil. The war in Ukraine and fallout from coronavirus lockdowns have resulted in massive supply shortages across various industries, from food to gas to electricity. Videos showing empty shelves across the US illustrate the extent of the problem. Rickards cites the 1970s as the last time the US faced such supply shocks, and even then, the stock market was not a useful hedge. The Dow Jones fell nearly 74% after 1965 and took nearly 30 years to recover. As prices went up, the values of people's retirement accounts plummeted. Rickards further argues that raising interest rates would not help, but rather harm the situation, using Japan's experience as an example in the 1980s. Japan faced a situation similar to the US today, with a massive asset bubble resulting from low rates and easy money. When the central bank decided to raise rates in 1989 to deflate the bubble, the stock market quickly fell by over 60% in just a few years, leading to the lost decade. Rickards warns that if the US were to experience a similar stock market crash, it would have disastrous consequences. Thus, the government and the Fed must find alternative solutions to address the current economic challenges caused by supply shocks. How to invest your cash? He suggests that the most likely time for the crash to occur would be in mid-June, when the Fed will make a decision on raising rates, leaving the world in limbo as people speculate on what they will do. If the Fed does decide to raise rates by more than 0.25%, as many anticipate, it could trigger a major sell-off in the markets the very next day. Rickards is recommending that investors take several measures to safeguard their finances in the event of a crash. 1. Have cash. According to Jim Rickards, having cash on hand is one of the most crucial measures to protect oneself during a financial crash. While it may sound counterintuitive as inflation erodes the value of cash, it is still advisable to have a decent amount of cash that can cover at least 3 to 6 months of expenses. Rickards believes that most people will get wiped out in the early stages of a crisis, such as a market crash, when they lose their jobs, homes, and watch their retirement accounts shrink. Therefore, having little cash on hand will ensure that one is well insulated against the coming storm. Another reason to have cash on hand is to take advantage of buying opportunities during a crash. Rickards recommends moving a large part of one's portfolio to cash because having liquidity will limit the downside during a crash and give plenty of ammunition to enter back into the market at rock bottom prices once the bloodbath is over. Having cash during a crash also allows one to capitalize on distressed assets, which tends to be sold at significant discounts. Furthermore, history has shown that having cash during a financial crisis has its advantages. In 2008, the market took time to recover, and investors who kept their money in the market had to wait a long time for it to recover. However, those that went to cash and bought even just a run-of-the-mill index fund anywhere close to the bottom of the market could have doubled their money in the same time frame. Therefore, having cash during a crash is not only a means of protecting oneself, but also a means of taking advantage of market opportunities. Having cash also provides peace of mind during times of economic uncertainty. When a market is in a state of chaos, people tend to make irrational decisions, which can lead to disastrous consequences. Having cash allows one to remain calm and collected, while others panic and make rash decisions that lead to more significant losses. In addition, having cash is a means of diversifying one's portfolio. In times of economic turmoil, traditional investments like stocks, bonds, and real estate tend to underperform. Therefore, having cash on hand is a means of diversifying one's portfolio and hedging against market volatility. This diversification ensures that one's portfolio is not entirely dependent on the performance of traditional assets. 2. Invest 10% of your cash in gold. Jim Rickards, a renowned financial expert and author, has been recommending investors to put up 10% of their portfolio in gold. According to Rickards, gold is the world's most indestructible asset, and it performs surprisingly well during times of crisis. He even refers to it as the single most important safe haven for what lies ahead. One of the primary reasons why gold is an attractive investment during a market crash is that it's not tied to the performance of the stock market. When the stock prices plummet, gold prices tend to rise, making it an effective hedge against market downturns. In fact, history has shown that during times of financial turmoil, gold prices tend to soar as investors rush to safe haven assets. Another reason why gold is considered an attractive investment is its intrinsic value. Unlike paper currency, gold has tangible value, and has been used as a form of currency for centuries. It is also a limited resource, and its supply is finite, which makes it resistant to inflation. As a result, many investors view gold as a store of value and long-term hedge against inflation. Gold is also a highly liquid asset, which means that it can be easily bought and sold on the open market. Unlike other assets such as real estate, which can take months to sell, gold can be converted into cash quickly. This makes it an excellent asset to hold during times of uncertainty, when the value of other assets may be in question. Investing in gold also offers diversification benefits. Most investors have a portfolio heavily weighted towards stocks and bonds, which are highly correlated. In contrast, gold has a low correlation with stocks and bonds, which means it can help to diversify a portfolio and reduce overall portfolio risk. Gold is a long-term investment, and its value tends to appreciate over time. While short-term fluctuations in the gold market are common, the long-term trend has been one of steady appreciation. This makes gold an excellent asset for investors looking to build long-term wealth. Lastly, investing in gold is relatively easy and affordable. Unlike other alternative investments such as real estate or private equity, investors can purchase gold in small quantities and store it in a safe location. Gold can be purchased in the form of coins or bars, and many other reputable dealers offer storage options for investors who prefer not to keep physical gold in their homes. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well. Thanks for watching.